Greetings and welcome to another session of our tutorial. We are going to be dealing on candlestick and candlestick patterns. If you like this kind of content, please subscribe to our YouTube channel and turn on the notifications. Alright, so let's look at the basic candlestick patterns we are going to be dealing on. Number one is bullish and bearish candle. Then we are going to look at engulfing bar, dragonfly, doji, hammer, shooting star, and tweezer. So those are the candlestick patterns we are going to look at in this video. This is actually what a bullish and bearish candlestick looks like. So before we go into that, first of all, you need to know that we look at market in terms of time frame when using candlestick. So okay, let's assume that this candlestick we are seeing here is a 5-minute candlestick. So this candlestick you are seeing here represents a 5-minute, what happened in the market within 5 minutes. Now let's look at the bullish candlestick, which is usually denoted by green, which is a rising candlestick. Alright, the point you see open is actually the beginning of the 5 minutes, because we are assuming here that this is a 5-minute candlestick. So the point labeled open is a point where market opened within that 5 minutes. Then if you see this bottom here, it is labeled lower shadow or low. That is the lowest point after the market opening. At that point, that is the lowest point the market fell to. And you can see up above, you see high or upper shadow. That is the highest point within that 5 minutes the market rose to. And then that point that you see labeled close, that is the point that market actually closed before opening another 5-minute candle. So within the 5 minutes, we can say that the market opened here, fell down to this low, rose up to that high, and then closed at that point. So that is what a bullish candlestick is. So the same thing also applies to the bearish candlestick, but in the opposite direction. A bearish candlestick, we assume that the market is falling. So the market was high before falling. So that point that is labeled open, let's also assume that this is a 5-minute bearish candle. That point labeled open is the point that market actually opened, and that high you are seeing there above is actually the highest point the market went up to after opening. And this side that is labeled low is actually the lowest point the market fell to. Then you see the point labeled close, that is the point that market actually closed within that 5 minutes. So this bearish candlestick shows the bearish market swing within that 5 minutes, and that's it. So here are examples of candlesticks that have long shadows. As you can see, the first one has upper long shadow. That is a bearish candlestick, that is a falling market. So when you see this kind of thing, know that sellers have high power in the market at that point in time, and they are quickly trying to push the market down. So when you see a long wick, yes, a long wick or a long shadow like that, it shows that market fell sharp. So the same thing applies for this one that is in green color, which is the bullish candlestick. It shows how buyers are in control of the market and they quickly pushed price up. That's why you are seeing a long wick at the bottom. Now let's look at the bullish engulfing pattern. As you can see here, we have two candlesticks in our front. One is red and one is green. The red one signifies a falling market and the green one signifies a rising market. So a bullish engulfing, as the name implies, bullish engulfing. Engulfing means for something to cover something. Then bullish means something is rising, a rising market. So when a green candle covers or swallows a red candle, That's the pattern we call bullish engulfing pattern. And what this means is that while market was falling, that is on the red side, as market was falling, it came to a point that market began to rise. We usually see this kind of pattern when market is reversing from falling to rising. So when you check your chart, if you check your chart, you see things like this, you see examples like this. So it is a point when market was actually falling, then at some point it started to rise again. So that is what a bullish engulfing pattern looks like. And the same thing goes for bearish engulfing pattern. So that is the same thing we have here, but in opposite direction. As you can see here, we see that the red candlestick, which signifies a falling market, actually swallows or is bigger than the green candlestick, which signifies a higher market. So as you can see here, the market was rising, then at some point it got to a point that the market began to fall. It printed a big red candlestick. That shows that market is reversing from rising market to falling market. So people usually say that there are two forces that are actually fighting in the market, the bulls and the bears. So as you can see in this candlestick, it shows that nobody has power over each other. As you can see this candle, you cannot see a body. The opening and the closing is at the same point. So this actually shows that the sellers here, yes, the sellers here and the buyers, they have equal power, and nobody can push price further than that point. So what you can see here is called indecision or a stalemate, where the buyers and the sellers have equal power at that point in time in the market. This is called shooting star or bearish pin bar. So I introduced something like this before, a long shadow candlestick. So as you can see, when you see something like this, it should come to your mind that sellers are actually in control of the market. This shows a quick rejection of market. When market went up to that high point, the sellers quickly pushed the market down to this point. So what you are seeing here is that the market may actually fall because sellers are in control of the market. That is why you are seeing a long shadow. Now let's look at tweezer. So first of all, we are going to start with tweezer bottom. So as you can see, we have a black and we also have a white candle here. Don't be afraid. The black candle is also the red candle, which is the falling market, while the white candle here is the green candle, which is the rising market. So here in tweezer bottom, this kind of pattern appears when a falling market begins to rise. As you can see on the left, the market printed a black candle or a red candle, depending on what color you put it. So the market was falling. From the top of this black candle, the market fell to the bottom of that black candle. Then after that time was over, let's say it was 5 minutes, within the next 5 minutes, market began to print a white or a green candle, and the market began to rise again. So when we see this kind of pattern, we know that the market is trying to reverse from a falling market to a rising market. So that's just it about tweezer bottom. So the opposite also holds for tweezer top. So we are going to look at it. Okay, now let's look at tweezer top. As you can see, the black, which is the red candle, is on the right, while the white, which is the green candle, is on the left. So here the market was rising. That is why you are seeing a white candle on the left. The market was rising, so it got to the point that the market began to reverse. It fell from the top of the black candle to the bottom of that black candle. That is to show you that market is changing direction. So that is it about tweezer top and tweezer bottom. In summary, all these candlesticks help us to predict market, although they are not accurate. You have to combine them with some other analysis and technicals before you can actually use them to trade. Alright, so we have an assignment. You are to go to 1 minute time frame on your MetaTrader 5 or TradingView app. You have to go to 1 minute time frame, switch it to 1 minute time frame, and you see how market prints bullish and bearish candles, which are red and green candles, so that you can have a first-hand experience on how these bullish and bearish candlesticks print and work. Thank you for watching.